BlackRock just dropped a $2.4 billion regulated fund onto Uniswap, a money market fund acting as collateral in decentralized lending. Remember when Larry Fink said that everything will be tokenized? Well, it's happening. And it is going to change what you can own, what yield you can earn, and who holds the power when the next interest rate cycle hits. The on-chain market for real-world assets just crossed $29 billion, growing 263% a year. By 2030, projections say $16 trillion. In January, the on-chain total was $21 billion. By April, $29 billion. That is 30% growth in a single quarter. Add stablecoins, and the total tokenized market is already past $240 billion, and only a tiny fraction of the $28 trillion US Treasury market has been tokenized so far. So the runway is enormous. But what is tokenization? Think about it like this. When you go to a casino, you trade your dollars for chips. Those chips represent real money, but they move faster inside the casino. Tokenization works the same. You take a real asset, like a building or a government bond, and you convert the ownership into digital tokens on a blockchain. First, you divide the asset into fractions. Then, you verify the underlying collateral through something like Chainlink's proof of reserve, and you mint tokens. Those tokens trade on exchanges and DeFi platforms around the clock. For example, a $25 million office building becomes 2.5 million tokens priced at $10 each. So you don't need $1 million to own a piece of commercial real estate anymore. You need $10 and an internet connection. That's the whole idea. But where is the $29 billion actually sitting? Let's start with the biggest chunk. Tokenized US Treasuries reached $13.4 billion by April 2026. They crossed $10 billion back in late February, and they haven't slowed down. Circle's USYC sits at $2.7 billion. BlackRock's BUIDL fund alone holds $2.4 billion. Ondo has $2.6 billion, and Franklin Templeton's Benji fund holds another billion. These are not experimental products. They are the on-chain risk-free rate. And in early 2026, BlackRock did something that would have been unthinkable 2 years ago. They put BUIDL onto Uniswap, a regulated fund serving as collateral in decentralized lending protocols. That is a landmark moment. It means the wall between traditional finance and DeFi is coming down. And what about private credit? This segment sits at $16.8 billion. It is the second largest tokenized asset class, and it is solving a real problem. Small and medium-sized businesses have historically been locked out of liquidity because their loans are illiquid and buried in paperwork. Platforms like Centrifuge and Maple Finance tokenize those loans so they can trade. Smart contracts automate the income distribution, and the administrative overhead drops by as much as 70%. So, instead of a business loan sitting on a bank's books for 5 years, it becomes a token that investors can buy and sell. That changes how credit actually flows. Now here's where things get interesting. Tokenized commodities reached $7.3 billion by April. Gold makes up about 70% of that figure. And Tether's XAUT and Paxos PAXG account for about 90% of that gold market. But here's the number that caught my attention. Tokenized gold did $90.7 billion in spot trading volume in the first quarter of 2026 alone. Compare that to all of 2025, which did $84.6 billion. The market is accelerating in real time. So gold-backed tokens are not just sitting in wallets anymore. They are becoming active trading instruments on centralized and decentralized exchanges 24 hours a day. One more thing, tokenized equities. This is the smallest segment at around $960 million. Ondo Finance holds about 60% of this market through its global markets platform. Monthly spot trading for tokenized blue chip stocks has exceeded $4 billion consistently this year. And the NYSE and NASDAQ are already building infrastructure for 24/7 tokenized securities. Public markets could settle as blockchain tokens right next to traditional rails by late 2026. In a world where 1.7 billion people still lack access to basic financial services, digital assets have the potential to open the door. That is not a theory, but an infrastructure being poured right now. Okay, so why is all of this accelerating? The answer is regulation, and the answer is 2026. In the European Union, MiCA became fully applicable on December 30th, 2024, but the real deadline is July 1st, 2026. After that, any crypto asset service provider operating in the EU needs full MiCA authorization, or they shut down. By April of this year, over 185 operators had already obtained licenses. That means they can passport services across all 27 member states. MiCA draws a line between asset reference tokens and e-money tokens. One is backed by a basket, the other is backed one-to-one by a single fiat currency. So the rules are clear. And for institutional money, clarity is oxygen. But that is what's happening in the EU. Here's how the United States has responded to Europe's progress by launching its own regulatory shift. The Genius Act passed in July 2025. It requires payment stablecoins to hold one-to-one backing with highly liquid assets like US dollars and treasuries. In March of this year, the SEC and CFTC put out joint guidance on how to classify digital commodities versus securities. And the SEC approved WisdomTree's tokenized money market fund for intraday trading with T-Instant settlement. That is the first time a tokenized mutual fund has been approved for same-day settlement in the United States. Congress is also weighing the Digital Asset Market Clarity Act, which could remove more barriers by Q4 2026. But the US and Europe are not the only ones who are rewriting the rules. In April 2026, Hong Kong's Securities and Futures Commission granted the first stablecoin licenses to Standard Chartered and HSBC. Singapore's Project Guardian, run by the Monetary Authority of Singapore, moved from pilot to operational roadmap for tokenized funds and government bills settled via wholesale CBDC. And Japan is preparing to reclassify crypto assets as financial products by late 2026. That could drop the tax rate on crypto gains from 55% to a flat 20%. When you lower taxes on a new asset class by that much, dormant capital tends to wake up fast. Now let's talk about who is actually deploying capital. Because this is where the story stops being about crypto Twitter and starts being about balance sheets. Morgan Stanley identified RWA tokenization as a top global business focus in April 2026. They are launching an institutional digital wallet in the second half of this year. And by late 2026, they plan to let institutional clients trade tokenized versions of select US blue chip stocks and ETFs on their own alternative trading system. JP Morgan issued the first tokenized asset-backed securities, and their Onyx platform is enabling treasuries to settle like crypto. Now that cuts counterparty risk and shrinks settlement from days to minutes. But the sovereign wealth funds are arguably the biggest signal. Abu Dhabi's Mubadala investment company sits on $380 billion in assets. Saudi Arabia's public investment fund holds $2.2 trillion. Both are actively tokenizing real estate and infrastructure to unlock liquidity. Back in the early days, DAMAC launched a $1 billion real estate tokenization project. That was one of the first signals that this was not a novelty. Singapore's GIC and Temasek hold a combined $700 billion plus. They are both in Project Guardian for tokenized funds. When sovereigns with that kind of firepower start tokenizing physical assets, you are not looking at a speculative trend. You are looking at a structural relocation of capital. And what that means for you and your money is simple. The biggest pools of capital on Earth are choosing on-chain rails first. You either learn how to use those rails now, or you watch the people who did pull ahead. And keep in mind, it is not just the giants. Companies like Lofty are tokenizing residential real estate, so investors can buy fractions of houses and condos. AgroToken lets farmers tokenize their harvest, like grain, and use those digital assets as loan collateral or payment. Even USDT, the original stablecoin, was arguably the first successful case of currency tokenization at scale. This is not one use case, but a pattern. So, how does this actually work under the hood? Ethereum is still the primary settlement layer for institutional tokenization. The ERC20 and ERC3643 are what most issuers use to mint tokens. But you also have corporate-grade options like Hyperledger Besu, Quorum from JP Morgan, Corda for compliance-heavy deals, and Tezos for projects that need strong on-chain governance. Execution is shifting to Layer 2 networks like Arbitrum and Optimism for speed, and Layer 3 environments like Nautilus Chain and zkStack by zkSync give enterprises custom privacy without exposing proprietary data on a public ledger. So the stack is no longer just one chain, but a system of layers. The interoperability problem is being solved by Chainlink's Cross-Chain Interoperability Protocol, or CCIP. It does not bridge assets the old way. It burns tokens on one chain and mints them natively on another. That keeps the total supply constant. And the asset on the destination chain is a native issuance, not a wrapped derivative. Chainlink has partnered with Swift to plug more than 11,000 financial institutions into multiple blockchain networks. And for privacy, zero-knowledge proofs let a transaction be verified without showing the sensitive data underneath. So, a bank can prove it has the collateral without showing the counterparty its entire book. Now, none of this is financial advice. I'm not a financial advisor. And before anyone starts throwing their savings at this, we need to talk about what can go wrong. First, custody. If you buy a token backed by physical gold, someone has to store that gold in a vault. Geopolitical risk and storage costs are real. If the vault operator fails, your token is only as good as the legal claim behind it. Second, liquidity fragmentation. A token on Ethereum cannot natively interact with a token on Stellar or Polygon. That creates silos. Chainlink CCIP is the fix, but cross-chain fragmentation is still an active problem. Third, price volatility. If the underlying asset swings hard like oil or silver, the token's peg can come under pressure. You need redemption mechanisms that actually hold up. Otherwise, you're holding a claim that may not redeem at par. Fourth, legal uncertainty. MiCA and the Genius Act created frameworks in the EU and the US, but plenty of jurisdictions still do not recognize digital ownership rights. If something goes wrong, you may have no court to sue in. And finally, smart contracts. They are code. Code has bugs. A thorough audit is non-negotiable before any issuance, but audits are not guarantees. They are just due diligence. So, before you buy any token, you are not just betting on the asset. You are betting on the code, the vault, and the legal system behind it. Now, tokenization is not just an upgrade for Wall Street. It is a mechanism that lowers the entry price for assets that used to require seven-figure net worth. Real estate, fine art, treasury bills, gold, you name it. You can now access fractions of these instruments with $10 and an internet connection. That changes who gets to participate. It changes who earns the yield, and it changes who holds the power when the next interest rate cycle hits. I personally think we are living through the early innings of a structural shift in how ownership itself is recorded and transferred. But maybe I'm wrong. Maybe the traditional rails are good enough, and none of this catches on at retail scale. What I do know is that the institutions with trillions in assets are not waiting for retail permission. they are building right now. So, what do you think? Am I wrong? Or did I miss something important? Let me know in the comments down below. And if this helped, hit the like button and subscribe. It's the best way to support the channel. Thank you for watching. I'll see you next time.